Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing DoorDash's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. DoorDash is a food delivery service. It launched in 2012. It has the largest market share for food delivery in the US. The company IPO'd on December 9th. Let's get started with the model. This is a large cap company, market cap $56 billion. They're trading at $175 a share, and they have 286 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has negative free cash flow in 2018 and 2019, but it looks like they broke even in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they have negative net income every year. Their revenue is growing exponentially. It nearly triples each year. 300 million, 900 million, 2.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses that are directly related to generating the revenue. Below that is gross profit, which is a difference between revenue and cost of revenue. They have a nice gross profit of 1.1 billion, a lot more than 362 million in 2019 or 63 million in 2018. They are a young company, so they have lots of operating expenses, 1.4 billion in the trailing 12 months. So each year they have negative operating income. The company has some debt, so they have to pay interest on their debt, and they have negative income, so they don't really pay much in taxes. The top line is operating cash flow. This is how much money the company generates through its operational business. In 2018, it was negative 160 million. In 2019, it was negative 470, but in the trailing 12 months, it was positive for the first time, 156 million. And capital expenditures are investments in property, plant, and equipment. And the way you calculate free cash flow, it's operating cash flow minus capex. It was zero in the trailing 12 months, which is great because it was negative in prior years. The company issues a lot of stock to run their business, 725 million in 2018, 1.1 billion in 2019, and $500 million in the trailing 12 months. So I like to look at operating cash flow as opposed to net income when I value a company because operating cash flow is the actual cash that goes in and out of the business. The income statement has some non-cash items on it. And the way you calculate operating cash flow, you start with net income. It was negative 283 million in trailing 12 months. Then you add back the non-cash items. So they had a 105 million depreciation expense on the income statement. So that brings down their net income, but it's a non-cash item. So we add it back on the statement of cash flows. We also add back impairments, stock-based compensation, and some other non-cash items. In order to calculate operating cash flow, you also have to adjust for changes in working capital. So the company had a positive $549 million in accounts payable. When a company uses accounts payable, that means they're receiving a product or service but not paying for it. They'll pay for it at a later time. So when you use accounts payable, it's similar to using debt. Even though they had positive 156 million in operating cash flow, they were able to do this by receiving $500 million of products that they didn't pay for, but they're going to pay for in the future. So this accounts payable will detract that operating cash flow in future years. It's just something to look out for and just to understand when looking at a company's financials. Let's look at a capital structure. They have $1.2 billion of equity, $184 million of debt, but they have negative 581 million of net debt. Net debt is debt minus cash. So if they use the cash on their balance sheet to pay down their debt, they would still have $581 million of cash left over. That's a good sign when investing in a company. Their WACC is 13.6%, which is a blend of the cost of equity and cost of debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 18 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 286 million shares. And we get a calculated stock price of $39. They're trading at $175. So they're trading at a 347% premium. It's a sell according to the model. Simply Wall Street values the company at $12. So they're saying the stock is even more overvalued than me. The company was founded in Palo Alto in 2012 and then started delivering in 2013. It received $120,000 from Y Combinator. In 2018, the company passed Uber Eats, but was still behind Grubhub in U.S. food delivery sales. Then in 2019, it passed Grubhub with 28% of total sales. The company raised $700 million over several rounds of funding. In June 2020, the company was valued at $16 billion, which is about 1/3 of what it's valued at today. Its current market cap is $56 billion. I value the company at $11 billion. The company acquired Caviar in 2019. This is an upscale food delivery service. In 2019, DoorDash acquired Scotty Labs. This company focuses on self-driving cars. Let's look at the financial ratios. The average PE in the market is 12.6. The median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have a negative PE. Price to sales is stock price over sales per share. They're at 22.6. That means investors are paying about $23 for $1 revenue, which is much higher than the median and average. Price to book is stock price over book value per share. They're at 42.4. They're also a lot higher than the median and average. The way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. They have $1.2 billion of equity, but they have negative $1.5 billion of tangible equity. That means they have a lot of intangible assets on the balance sheet. Intangible assets are goodwill, patents, trademarks. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They're at 2.6, so they can easily cover their current liabilities with their current assets. Their current assets are $765 million of cash, $58 million of receivables, $125 million of prepaid assets, and $50 million of restricted cash. So in the trailing 12 months, they had no free cash flow, but they have $600 million of working capital. Working capital are current assets minus current liabilities. So it appears that they're well funded, but these numbers don't include the money they got from the IPO, so they're really well funded. The best way to look at ratios to compare them to similar companies, I've done videos on Spotify, Airbnb, Facebook, Alphabet, Groupon, Match, Pinterest, Trivago, Twitter, Yelp, and Yandex, all in the same industry as Dash. And if Dash has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they have a huge negative. Their price to sales is double what the average is. Price to book is much higher than the average. They have a fine current ratio, but it's lower than average. ROE is negative. They have less debt than average, which is good. It doesn't seem like they use much debt to run their business. They're mostly using equity. And their market cap is pretty high, $56 billion, but it's still lower than the average of $94 billion. So to summarize, I have them trading at a significant premium because it seems like the stock is way overpriced for what they're worth. But this usually happens with new IPOs. It's exciting and investors drive the price up, but it should come back down. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.